A lot of people I speak to about moving abroad think that once they leave the UK, they stop paying UK tax. And in some cases, yes, that's true. But there's a really important set of rules that can completely undo the planning if you're not careful. They're called the Temporary Non-Residence Rules, or TNR for short. And they're one of the biggest traps for people leaving the UK for tax reasons. Now, if you've heard of the advice, just move to Dubai and pay no tax, this is the part of the law that catches people out. In this video, I'll explain what the Temporary Non-Residence Rules are, how they work, and the types of incomes and gains that they can claw back, and finally, what you need to do if you're planning to leave the UK. If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor at Seymour. I train at a Big Four firm in their private client team, and I now advise business owners and families on inheritance tax, company structuring, and long-term wealth planning. So let's get into it. What are the Temporary Non-Residence Rules? Well, the idea behind these rules is simple. They stop people from leaving the UK for a short time, taking advantage of another country's lower tax rates, or no tax at all, and then coming straight back. The rule says, if you leave the UK, become non-tax resident, and then return within 5 full tax years, certain income and certain capital gains that you received while abroad can still be taxed in the UK, as if you never left. So it's essentially HMRC saying, fine, you can go, but if you come back too soon, we'll treat the whole thing as if you stayed. So how does this work in practice? Let's take an example. Say you've built a successful UK company that's accumulated £1 million in retained profits. You decide to move to Dubai, where the income tax is 0%. Soon after leaving, you pay yourself that £1 million as dividends. On paper, that looks like a clever move. No tax in the UK and no tax in Dubai. But if you come back to the UK within 5 full tax years, HMRC will treat that dividend as if you'd received it while you were UK resident. Meaning, you'd be taxed in full on that £1 million, even though it was paid to you while you were abroad and you've probably spent all the money. That's because the profits were earned while you were UK resident. They're called pre-departure profits, and the TNR rules are designed to catch exactly that. So the timing of when you earn the profit matters just as much as when you pay it out. Now, let's talk about capital gains tax, because this is where the stakes can get really high. You've heard of people moving abroad to sell their business, especially places with no capital gains tax like Dubai or the Cayman Islands. In theory, it works. Because you become non-resident, sell while abroad, you shouldn't pay UK capital gains tax. But under the Temporary Non-Residence Rules, if you return to the UK within the 5 full tax years, that gain can be clawed back and taxed in full. So if you sold your business for £10 million while abroad and would have paid around, say, £1.9 million in UK CGT, you don't avoid that unless you stay away for the 5 full complete tax years. And that's a long time when you think about it. And that's where a lot of people's plans can start to fall apart. So what counts towards the 5 years? It's 5 full tax years, not 5 calendar years. So if you leave in June 2025, your first non-resident year starts from 6th of April 2026, and you have to stay non-resident until at least 6th of April 2031 to be outside of that window. That can catch a lot of people off guard, because they think 5 years means 5 summers abroad. But HMRC counts tax years and not time spent away. Now, it's not just dividends or gains. Other types of income can be caught too, including certain pension lump sums, distributions from closed companies, trust distributions or benefits from offshore structures, basically anything where you have control over the timing of the payment. HMRC doesn't want you to just defer income until you're non-resident and then take it back tax-free. But there are a few things that are not caught, a few important exemptions. Employment income. If you work abroad and are genuinely non-tax resident, your salary is taxed where you're resident. Post-departure profits. If your company continues to trade after you've left and it earns new profits while you're abroad, those profits won't be caught by the TNR rules. Some overseas investment income as well, depending on your residence and treaty resident position in this case. So it's not that all foreign income is taxed. It's about whether it relates to the tax period you are still UK resident, essentially. Another big misunderstanding is around UK property. Some people think that if they leave the UK and sell a rental property, they can avoid tax completely. That's not true. Even for non-residents, UK property is always within the UK tax net. And if you sell while abroad and then come back within 5 years, HMRC can tax the entire gain, not just the part since 2015 when the rebasing took effect. So unless you're planning to genuinely leave and stay out for the full period, there's no UK tax advantage in selling while abroad. So what can you do if you're thinking about leaving the UK? Well, the first thing is to plan early. The statutory residence test is the foundation. You need to make sure that you genuinely become non-resident. That means days, ties, work, and home all have to align. Secondly, think long-term. Ask yourself if you can actually stay non-resident for 5 full tax years. Because if you come back too soon, all of those tax benefits can unwind overnight. Third, identify what profits and assets are pre-departure. If your company has already built up retained earnings, you might need to plan how and when to extract them. And finally, get proper cross-border advice. You'll need to consider split-year treatment, double tax treaties, and local tax rules in your destination country. This isn't just about UK tax, you'll need to understand the full picture. So finally, the TNR rules are one of those hidden traps that most people don't find out about until it's too late. They're not designed to stop you from moving abroad. They're designed to stop you from doing it temporarily just to avoid tax. So if you're serious about leaving the UK for tax reasons, you need to plan properly, both your departure and your return. Because if you get it wrong, you could end up with the same UK tax bill you were trying to avoid, plus penalties and interest on top. If you found this helpful, give it a like and subscribe for more, and check the links below for my full video on the statutory residence test. That's where all of this really starts. And if you're planning to leave the UK and want to make sure you do it the right way, feel free to reach out. This is exactly the kind of planning we help clients with every day. See you in the next video.